Schroders Private Banking, and Kieron Launder, the group's Chief Investment Officer, joins us in the studio now. Lovely to have you with us, Kieron. And so a key driving factor for you in your investment strategy is this whole deleveraging process. So why is that? What are the implications of consumers and businesses saving more and spending less?
Well, I think the theme of deleveraging is considered quite long-term, but it actually meaningfully affects the different segments of society, whether they be individuals, whether they be corporates, whether they be governments. The size of the deleveraging that needs to happen obviously depends on the amount of debt originally, so the size of the issue is important, but also the flexibility that they have to work through that deleveraging. And that changes from whether you are an individual or a corporate or a government, and indeed from country to country. So I think what we're seeing is the speed through which countries and individuals and corporations move through the deleveraging process. We're seeing very real impact on the economies and people's behavior.
And will they continue at the pace that they're going at now? Because, you know, for example, there are some investors or analysts saying as the year progresses, we could see banks, for example, increase their lending. So instead of using that liquidity from the ECB to invest in European sovereign bond markets, that they might actually increase their lending to, say, small and medium-sized businesses feeding through into the real economy. Is that something you're expecting?
Well, it's certainly something that banks are saying and talking about. I mean, UniCredit yesterday was saying that actually, 28 billion is now available for new lending. We haven't really seen that yet. And actually, February, European bank lending to non-financials was down. The speed at which you restart, as I said, what was the size of the mountain that you had to delever to begin with, and how quickly have you been able to do so? We've seen very, very quick deleveraging out of financial institutions in America, which didn't have the same scale of problem, so actually they are lending quite nicely. In Europe, we're expecting it to come through, but people need to have confidence. Banks are run by individuals, they're being asked to deleverage their balance sheet by governments and by regulators, and to start new loans, you've got to combine the deleveraging and look at the bad assets that may be clogging up the system.
So tell me then, in terms of bank valuations, are they attractive to you right now, European banks?
I think they are reasonably attractive, but I think that it's unlikely that we'll see a return to the same levels of return on equity that we've been used to. Yeah. So I think actually, in historic perspective, price to book,
it'll be harder to maintain profitability.
It'll be harder to maintain profitability, absolutely.
So the deleveraging process, that's a key risk for the long-term investor. I'm wondering about then how closely you're watching distortions in the market from monetary policy, the Fed's near zero interest rate policy, QE, Operation Twist. I mean, it's meant that investors are looking for higher yields from risk assets, but what are the risks to all of that?
Very good point. I mean, it's whether you call it financial repression or whatever you want to call it, quantitative easing and the influence and the involvement of governments in markets has made a massive difference. The yield curves, which of course is the official price of money, is not necessarily the same as the real price of money that actually people can access. We are seeing a very direct impact on corporations. The bond issuance so far this year has been very, very significant, but the financial environment for smaller and medium-sized companies is still really quite difficult.
So how are the risks, I mean, presumably you'll be watching the way in which the unwinding of this central bank liquidity, let's put it like that. How difficult, how painful a process is that going to be, and how does all that impact the way you invest in government bonds?
Absolutely. Now that governments are part of the markets as opposed to just influencing policy and short-term rates, you're absolutely right. How they unwind is going to be an extremely sensitive operation, and it's likely that we will get further QE because they are part of the market. It's very difficult for them to have a binomial policy where they just stop and rates shoot up again as the buyer of the last resort isn't there anymore.
Does that mean that you're long on equity markets? Is that what you would recommend?
I think we've not liked sort of sovereign debt for some considerable period of time. We have a bias within bond markets towards sort of credit and perhaps inflation-linked. Equities, absolutely for the longer term, but sticking with quality, and that's quality of balance sheet as well as quality of earnings. Because I think having flexibility is incredibly important.
Well, Kieron, I just want to pick up on the point that you made about corporate bonds. You prefer the corporate bond market to sovereign bonds, presumably because, well, the returns are better. But are you also worried about volatility in credit spreads?
Not in the quality end. I mean, no. I think higher up, absolutely. But volatility, I think, is something that investors have got to learn to live with, and that's part of the official Fed policy and other central banks, crunching interest rates and encouraging people to take risk.
It's the end of the first quarter. We've had a great run. Your bias is still towards equities, but how much cash are you prepared to move across into equities as we go into quarter two?
Well, I think at this moment we are expecting almost a roll-off in data, and there's quite a lot of seasonal evidence saying that actually, the quarter that we're coming through, a lot of the comparisons are quite good, but we would be sort of in more of a buyer on weakness rather than adding at the moment, given seeing confidence and slowing down in areas around the world, Europe in particular, but we're sort of expecting to pull back, but we'd still, in the longer term, be adding to quality companies.
And when you look at quality companies, is that dividends, cash, or is it growth? I mean, the three classic divisions. Look at what Apple did in this quarter. I mean, that was a big move. So, out of those three sort of drivers, what do you think is going to appeal for you?
Well, I mean, I did mention to Maryam, I think the quality in terms of earnings. So, actually having strong, visible earnings, having sustainability of earnings is really important. So that comes down to quality of company, quality of management, and quality of balance sheets. I think if the world has told us nothing, the more that you are in control of your destiny, the better you're going to be.
But I suppose there'd be a lot of people, investors out there that don't feel that way because I guess of lack of visibility on the sort of macro front, and then of course you throw in the impact of regulation on, say, banks and financial institutions. There are a lot of uncertainties out there, and actually one that I wanted to speak about a little bit more was China, because you say that Asian equities are cheap right now, valuations are attractive, but is there now more focus amongst investors on how this transition period in China what that could mean for economic growth, and that feeding through into earnings as well, even the solid companies?
Sure. China naturally has to slow down, whether it's the law of large numbers, whether it's actually a different part of the industrialization phase, the numbers should slow down. They're still incredibly healthy. They have very strong sort of government balance sheets. They have the sort of political will and the political duration, barring sort of minor skirmishes we've seen behind the scenes recently, to actually have the...
You just glossed over that.
Well, yeah.
Barring minor skirmishes. What do you mean minor... What are you talking about?
Political interaction where, one of the...
Bougie lions.
Bougie lions, yeah. Exactly. And, they do have longevity in terms of planning and technocrats to be able to take that into account.
The 5-year plan.
So I think, they can stick to that.
Come back to Europe, because one of the themes that came through, especially from the Italians, and we've spoken to one or two of them, is that they're about to, whether they do this or not, which is, we got some money from the ECB, we're going to use that for the real economy, believe it when we see it. But is that a risk? Is that a risk that this up move in the peripheral bond prices is going to end, and actually there's a risk actually in terms of where the money goes?
I think there is a risk in terms of where the money goes, and there's a whole transmission mechanism. It's quite easy for the finance ministers, I think, getting together in the next couple of days, and they will say, well, look, the LTRO, we've bought ourselves time. Now it's up to you to make sure that, and this has been reinforced by Merkel, by Wiedmann, saying, actually, we've bought time through the LTRO, but now we've got to see real addressing of budget deficits, which, of course, is really tricky in terms of the deleveraging. Governments have to come last, because apart from their normal role of counterbalancing sort of cyclical behavior, is cyclical deficits make the problem worse, and they haven't started to address anything structural, which is what Monti and Rajoy are just starting to do, and we know it's going to be a long, long haul.
So then let me ask you, because recession in Europe is one of the key risks that you're watching. We've covered the slowdown in China. What about the US? Another of your key risks, a reduction in government spending over there, triggering a slowdown. And yet we have the OECD just this morning saying, actually, we're seeing a decoupling process between the macro situation in the US and Europe. So you're skeptical about that?
I wouldn't say skeptical. I think it's right to say what are the risks, and of course the US has traditionally been the engine of growth, and the consumer, Western consumer is about 70% of GDP. America is still 30% of global GDP. Multiply them together, the US consumer de facto is about 20% of global GDP. Really important that they continue to spend.
But I suppose your point is about domestic politics anyway,
well,
and what happens after the election, yeah?
Absolutely, and the structural deficits and the government deficits overall level in America is still very sizable. America has taken a very different stance for going for growth first. When we get economic traction, only then will we start to address the deficits.
I don't think the rest of the general US public have actually caught that point.
Okay. Kieron Launder, Chief Investment Officer, Schroders Private Banking. Thank you.